Hi, everyone. This is Tony D'Amico with Fidato Wealth. Wanted to put together just some information for everyone out there. So obviously, the coronavirus is become a really obviously national headlines and a big challenge for not only the U.S. but many countries. So, but I really want to focus on today is looking at some data, how epidemics have played out in the past, how markets have reacted, and really just, I think, some important information for us to stay focused and calm on what we can control. So I previously sent this out in an email, but I did take a look at some data that showed these different epidemics that spread and were, pretty fatal in a lot of situations. And if we look at the financial impact or how the S&P 500 reacted, you could see in all but two cases, the S&P 500 was up 12 months after the epidemic started. So now, does that guarantee that the markets will be up 12 months from today? No, it doesn't. But again, we do have some history on our side. We can evaluate data and see how markets have reacted in the past. It's also very important to remember that volatility is expected. So I know many of you have seen this slide either as part of your new client onboarding process or perhaps at the retirement planning class that I teach. So we do expect volatility. And you can see here in the far right-hand corner, there's a 20% or more decline to stocks on average every 3.75 years. And you can see the average length to recovery is about 338 days. And when we look at the S&P 500, it is down now over 20% from its high. It's also important to remember that market timing is something that we don't do whatsoever because it could be very costly. And so this data here is updated every year, and every year it shows us the same thing, that those that remain invested get the best return. And that the best days, so this slide shows here that 6 of the best 10 days occurred within 2 weeks of the 10 worst days. So if you stayed fully invested in the S&P 500 over this 20-year period, your 10,000 would have grown to nearly 30,000. This next spot here is if you were invested 20 years, but just minus those 10 best days. As you can see, it cuts your principal in half. And that is obviously something that somebody may not be able to recover from if they do that. So that could result in a permanent lifestyle reduction. So it's imperative to not try to time the market. So what do we do know is that emotional investing mistakes, again, result in permanent lifestyle reductions. So you've all heard me talk before about behavioral finance, which is a study of people's psychological and emotional decision-making process or lack thereof with finances. So it's very important. We know most people buy high and they sell low, as this chart shows. And this has been studied extensively. So we have to have that mindset and think just like what Warren Buffett says, be fearful when others are greedy and be greedy when others are fearful. So we have to keep that in mind and stay calm with this challenging situation. So, are we headed into a recession, or is this the bear market? Let's talk about recession. So if it is a recession, how long do they last? So the average recession lasts on average 11 months. You can see here the change to GDP growth, and the average S&P 500 return is 3%. But thankfully, expansions, the average expansion is 67 months. And look at the total return for the S&P 500 during those periods. It's 117%. And, it's really important to remember, while this correction has been very severe, and there's a lot of unknowns with the coronavirus as that settles out, there have been some substantial corrections since January 1st of 2009. As you can see here, there was 5 or 6 corrections, actually 6 corrections above the 10% range. There was one at 15%, 18%, 19%. So this is not the first time that this has happened. And I think it's important to note, I started in financial services in 1999 and started Fidato Wealth in 2008. So we've been through these times before. 2008, 2009 were very volatile, and there's been volatility since then. So we've seen this before. We know what to do to take advantage of these opportunities for our clients. So let's talk about bear markets, because you're going to start hearing on the news, if you haven't heard already, that perhaps we've entered bear market territory. So bear markets tend to be short-lived, but a bigger decline. So you can see here, the average bull market lasts 71 months and has a total return of 263%. Now, this is obviously if you're all U.S. stocks, which nobody is all stocks that I know of. If we look at the average bear market, so it's down 33%, and it lasts about 14 months. So that kind of also goes along with that previous slide that showed that there is a 20% or more decline that happens just about every 3.75 years, and that time to recovery. So it might take a year to see that full recovery with the declines that we've had. It could be shorter than that. It could be longer than that. So very important to note that December of last year, we had sharp declines and the market rebounded very quickly. We just don't know. But again, we do know that bear markets, although the downturn is steeper, they tend to be short-lived. So diversification, and again, I know our clients that have been with us for several years have heard this message over and over again. But the reason why that every client should have some portion of their portfolio in bonds is because bonds 97% of the time, not 100%, but 97% of the time, move in a different direction or random direction than US stocks. So this is taking a look at the aggregate bond market and looking at specifically here to high quality or investment grade bonds. These are not reflective of how high yield bonds respond, because high yield bonds have a tremendous amount of volatility of that in them. And they, there's been a ton of volatility lately there, and they tend to decline as well when stocks decline. So we do not invest in high yield or what are called junk bonds for our clients. So if you look at the aggregate bond market index with these different corrections, so bonds have, during those periods of time, have been that successful ballast towards risk. As you can see there, in all scenarios, they were all up a certain amount. Also, too, we know that markets are random and unpredictable in the short term. It's very important that we keep that in mind. I want to show you a very rough decade. That was 2000 to the end of 2009. The S&P 500, if you were a disciplined investor, your reward would have been a negative 1% annualized rate of return. The aggregate bond market returned 6.33% during that period of time. So again, bonds, the goal of having bonds is for times just like we're in now. And also, too, the importance of, ironically, or this might sound strange, but it's true, but being globally diversified. And we do have a home bias, you call it, or a U.S. bias. So, the vast majority of the stock portfolio is in U.S. stocks, but within those U.S. stocks, instead of just investing in large company stocks, There's also mid-sized company stock exposure, small-sized company stock exposure, which is what is being portrayed here, coupled with 30% in non-US. And for that, that includes international, emerging markets, and real estate. We include real estate in that portion of the portfolio as well. You can see there during that decade, having that global diversification would have yielded a better rate of return. And I always remind people that even if you were invested this way, you would not have felt like you won because you wouldn't have had this chart to show you the progress along the way. So what is kind of behind the diversification, or what makes a diversification possible? And I'll talk about one statistical term with you today, and it's called correlation. And what that is a statistical measure of how two securities move in relation to one another. So, and I've kind of simplified this. So in our portfolios, there's 14 different funds that all invest in specific asset classes. So each fund has a high degree of asset class purity. But let's stick with correlation here, and I've kind of simplified this example. This is just all US stocks. International has a 0.83 correlation. So what that means is that 83% of the time they're going to move in conjunction, but 17% of the time they're not. Oops. Here's emerging markets. So again, about 25% of the time they're going to move in random directions as compared to one another, or different directions. The green bar is real estate. So about half the time, real estate will move in different directions than US stocks. And then finally, if you look at bonds, so bonds 97% of the time, they're going to move in a random direction as compared to US stocks. And that's what we want. We want, while stocks are not doing well, bonds to do well. All right, so this chart here maps out 14 different asset classes over the past 12 months. And you could see here these significant declines in, you know, not all 14 holdings, but about 9 to 10 of them. So about 4 to 5 of them are either up, are up. So, so you can see here, there's about 4 lines that are up a little bit and then up a decent amount. So bonds have done well the past 12 months. And on top of that, there's certain aspects of the bond portfolio that are very conservative. So if you are taking distributions from your portfolio, as you know, we do what's called threshold-based rebalancing. It's much different than just taking a calendar-driven approach to rebalancing. So the system will know which positions are up the most and sell those to fund your distributions. So in this particular circumstance, if you're a client that's taking distributions and we need to free up cash, there's 4 positions that we can go to that are either neutral or barely up a little bit, 1.3%, or up as high as, it looks like 8% or so. So we have 4 positions that we could sell to fund your distributions. So chances are that there will be positions that are either neutral or up to fund distributions. Conversely, for clients that are adding to their portfolios, and you know, we've had several calls where people have had too much cash on hand and are viewing this dip as the opportunity to buy, right? These opportunities don't come that often. And it's really important to try to take advantage of it in any way you can. So if you're, again, if you're adding to your portfolio, then obviously when we go to make those buys, we are going to buy the things that are down the most, right? So what threshold-based rebalancing is, it's a systematic way to sell high and buy low. And as our clients know, we've done a rebalance on our client accounts about 4 times now. So actually 4 times to be specific, since the volatility started with the coronavirus. And the goal there is it would sell positions that are up and buy the ones that are down. What we want to do is try to accumulate more shares at a cheaper price. average down your cost per share. So that way, when the markets do recover, the math is straightforward. It's your number of shares times share price equals the value. Right now, what we can control is the number of shares. We can't control the share price. But by controlling how many shares that are purchased, when it makes sense, when those thresholds are crossed, that's what we can do. And rebalancing has been shown to reduce risk noticeably, and then also slightly improve returns. And that's the name of the game. All right, so it's also important to note, we talked about the bond part of the portfolio. We did make adjustments to the bond portfolio in November 2018. And those adjustments had this in mind. We did get a tiny bit, I would say a little bit more, not even a tiny bit, a little bit more conservative with the bond holdings. So we introduced the Federated Prime Fund, which invests in short-term debt instruments. And that fund maintains the value of $1. And what varies is the amount of interest it receives. So it's a conservative position, a very conservative position rather. And we also invest in short-term bond funds, and that would be considered very conservative or conservative. And then also bonds have been up too. So the reason why we did that is that we, to the best that we can, not have volatility be a deterrent. So that Federated Prime Fund makes up about 3% of our clients' portfolios. And what we find is that people in retirement, they're typically spending down their portfolio. It varies. There might be some years where you're maybe taking more trips earlier in retirement, but it generally ranges from 3 to 5%. And so the chances are, again, that there'll be positions that we could sell to fund your distributions for the next upcoming year. So that's kind of the science behind that. We know that those positions aren't going to overlap because they're not correlated. And that's the sign of a good portfolio. Good portfolios can be frustrating. Really lastly, I want to talk about some things that we can control, right? We know that we can control our emotional reactions, stay disciplined. And if anything, when it comes to investing, if you can, perhaps you were thinking about investing funds this year, you had cash on hand, or maybe you can accelerate an IRA contribution and do it now. Or perhaps you were thinking about increasing your contribution to your 401k. Now is the time to really think about doing that. Now, the market may still continue to go down. No one can call the bottom, right? But those are things that you can do at this point in time. And so we're 100% focused on doing two things: staying calm and focusing on what we can control. And there's a lot there. Another thing that you could potentially do is accelerate Roth conversions. Now, to do that, there has to be a lot in place to do that. You don't want to just do a Roth conversion unless there's been a tax analysis done for the current year. So that's important to note. But that's another, again, potential benefit is to do Roth conversions. And with Roth conversions, when you do those, you're not selling positions and creating money and converting the cash. You're actually converting shares. So if you can convert more shares, then that's even better, because when the markets do rebound, then you have more that's in that tax-free account. But a little bit about comprehensive financial planning. So for our financial planning clients out there, it's really important, and it's why that we help all of our clients not only start a comprehensive financial plan, but build on it each year. Okay. So in this particular example, this particular person has a 99% probability of success. So again, you all know what that means, but in this scenario, there's the person's goals, when they want to retire, what they want to spend, their life expectancies, and the background is inflation, taxes, all those sorts of things. and it does a stress test across 1,000 probable outcomes, kind of across a standard bell curve of probable outcomes. And in this case, there's a 99% chance that the money will last as long as they do. So it's a very high probability of success. And there's 3 different zones, if you will. We don't have clients, or if we have a client within this less than 70%, we're, really working with them to get that fixed immediately, because that's very precarious. We always strive to have our clients' plan have a probability of success or 85% or greater. So if your plan does not have an 85% probability of success, we've addressed that with you, and you need to determine if you're still comfortable like you were prior. Okay. But this is the importance of having that comprehensive financial plan and having a probability of success that you're comfortable with. You can see the description for being in the confidence zone is a good balance between current and future lifestyle, and it may hold up well against future shocks. So that shock isn't in the future, it's now. And again, this is why we go to this extent of coming up with an investment plan that's not just based upon somebody's risk profile score, which is very important, but also based upon their financial plan, and making sure how that they're invested coincides with this. And you can see what the above confidence zone means. It's you should be above 90% if you're ultra conservative with your financial planning. So very important there. So really, again, what we're talking about today is focusing on what you can control. And it's really identifying and knowing what matters to you and what you can control. And then where those overlap is where you should, and we do, double down on our efforts. So let's kind of in conclusion, let's talk about that perspective and what some takeaways are. So number one, it's important to remain invested and keep that long-term perspective. Okay. Number two is, there's going to be all sorts of commercials that are going to come out here, food insurance and all these sorts of things. And some of them might be justified. We'll see commercials. You're going to be seeing so many commercials for gold and silver. You really need to guard yourself against commercials and programs with agendas. So have a well-diversified portfolio is really important. And that's obviously what our clients count on us for. Having that comprehensive plan. And then, and obviously reviewing that, which is what we do with our clients every year, is review their plan and chart out planning activities that we can work on mutually together over the next 12 months to continue to build that plan. And that brings us to number 5, is that you should continue to implement things that further your best interests. And I previously gave you a whole list of them prior. And if you don't have cash to invest because you're maxing out your 401k, just continue to do so. Even if our clients are retired and they're obviously not saving any more money, we are handling the rebalancing of your accounts. So what you can do then is remain calm and take those precautions. So we've sent out an email to you prior of all the precautions that we could all take to prevent the spread of the coronavirus. Okay, so with that, I just want to thank you for attending or watching this video, rather. I hope you found it really helpful. If you have questions or concerns, we're here. So our priorities are our team, ensuring our team stays healthy with all the precautions that we're taking, and taking care of them, and then our clients, our existing clients. So in times like this, we do prioritize activities for existing clients, and we're here for you. If you have questions, we'd be more than happy to hear from you. So feel free to reach out to our office, give us a call, or give us an email, and we'd be happy to hear from you. So again, thanks for watching, and I hope you and your family stay healthy, stay safe, and again, focus on what you can control. Thanks very much.